Hello, everyone, and welcome back. Thanks awfully for joining us for this latest BKL webinar. Today, we're going to be covering alphabet shares, a topic that is, should we say, a little bit controversial, Helena? Certainly a few areas of misunderstanding that we'll do our best to enlighten you all on in the next hour or so. So joining me, Helena Kangsula. Thanks, Helena, director here at BKL. Much to cover in the next hour, but if you'll forgive us for a little bit of indulgence, just a little bit about our good selves here at BKL. We are now up to over 400 people. How scary is that, Helena? 450, I think. 39 partners, it says there. I think we're going to need a bigger table. And it says more than 50 members in our tax team. I think they've forgotten to add VAT on there, because I think there's at least about 70 of us now. And we're also very honoured and delighted to be a certified B Corp these days. So we do try our best for the environment and to do the right thing generally. So top 50 accountancy firm with offices now in the centre of London and here in, well, I was about to say sunny Finchley, but well, maybe not quite today. And we're delighted to say last week we did it again, didn't we, Helena? We absolutely did. Best corporate or business tax team for 2024 at the Tolley's Taxation Awards. Brilliant. And as much as we'd love to take all the credit, I think it's a reflection on a brilliant firm, a brilliant tax team. And we must mention, we don't wish to make him blush, our brilliant wordsmith, David Goldstein, who turns what we do into poetry. So thank you, David, and all our marketing team for their efforts on that, and to David and Lola for their help in the background on these webinars. So best corporate or business tax team for 2024, but that's not all. We were best employer in tax last year at the Tolley's Awards. At the Accounting Excellence Awards, we were Tax Team of the Year in 2023. And we should, of course, mention our learned colleague, Sam Inkersol, who was a Rising Star of the Year. I think it was 22 or 21, Helena? 22. 22. Well done, Sam, who's currently in sunnier climes. So a brilliant tax team here, and it's just got even better because we're delighted to welcome our colleagues from Wilson Wright, who've joined us from the 2nd of April. 130 people they've brought to the party and a fantastic tax team as well. So we've really enjoyed getting to know them. Hopefully you'll get the opportunity to meet them and to hear some of their expertise on future webinars. And we look forward to introducing you to them all over time. In the meantime, if you do want to hear more from BKL, there's loads of great stuff on our website. Do have a look there. There's David Wiscombe's suitably tongue-in-cheek and brilliantly written Brass Taxes, which cover topical developments in tax with a definite hint of humour in there. I think you'll enjoy them if you haven't seen those already. So do register for those on our website. The link's there, together with our Tax Dispatch that summarises all our contributions to Tax Journal, Taxation Magazine, internal articles, which we send out on a, well, 2 or 3 monthly, slightly ad hoc basis, but do keep an eye out for that. And all of the webinars we do are also available on our website or via our YouTube channel. So feel free to contact your normal BKL contact, but there is plenty of material online as well, if you would like. So, OK, enough already. We've got a lot to cover today. Helena, what are we going to be covering today on alphabet shares?
Well, I'll explain and as we go along why we are here and why we're talking about alphabet shares, but effectively what we're going to be looking at, as you said, some of the common areas of misunderstanding. We're going to really be focusing on some of the income tax rules, the anti-avoidance rules, but also looking at some of the case law and also HMRC's approach to shares with differential rights. And then we'll be looking at a few scenarios if we get time at the end where alphabet shares maybe in points.
OK, so quite a few misconceptions here, and I don't think the Revenue done us any favours over the year. We'll look into their published guidance. We're going to focus on the settlements legislation and the employment-related securities rules as we go through. Just before we do get into the details, if you've got any questions, do feel free to type away. We'll try and answer those as we go along, or we may just send some responses when we circulate copies of the slides and a link to a copy of this webinar afterwards. But we do appreciate your comments and thoughts, and particularly with a topic like this where to be honest, I think, as we'll point out, we don't necessarily agree with some of the revenues guidance or interpretation. You may have your own views on that, so feel free to disagree. Hopefully we can all learn something from today's session. So that sets the scene. Let's just start by looking at profit extraction generally, Helena.
So one of the key focuses around a lot of the legislation which could potentially apply in respect of Alphabet shares relates to profit extraction. So as we know, with an owner managed business or company, there are various ways to take cash out, be it salaries, there may be property that is rented out, etc. But dividends can be quite a flexible way to extract profits across different types of shareholder. Especially in a family scenario, you could see how there may be various advantages. So the relevant rules that we will be looking at are those that relate to when income could arise to someone else other than the shareholder who receives the dividends, and also various employment tax rules which could treat dividend as something other than dividend income.
Okay, just to sort of set the scene a bit further, I mean, the problem with dividends is if you've got a single class of shares, your starting point is you have to pay out dividends pro rata to those shareholdings, and we'll see how Alphabet shares can be used in that scenario. Unlike salaries, where I guess you can pay anyone, well, anything you really like. So let's just explore that a little bit further. Let's start by looking at rates of dividend taxes, Helena.
So there've been various changes over the last few years. I mean, these are the rates for 24, 25. You can see everyone's entitled to a dividend allowance. That's come down quite significantly. And tax rates can go up to 39.35%. So, if you had 100% shareholder extracting all the profits of the company as a dividend, actually today, it is not as tax efficient as it used to be a few years ago. However, if there was an opportunity, for example, to shift income into the hands of those that are paying tax at basic or higher rate, you can see overall there might be tax savings for all the shareholders.
Yeah, and these rates are lower than the corresponding rates for general income, such as salaries, but that's a little bit misleading, isn't it? If it's a salary, you've got NICs to take in account, but salaries are generally tax deductible to the company. I mean, yes, wholly and exclusively, but we'll save that one for another day. Would it be fair to say, Helena, there's not an awful lot of difference in most cases between being remunerated by way of salary and dividend these days?
Yes, if you're extracting out at the higher rates of income tax, there really isn't an awful lot.
There's not a lot, I think. So I mean, there are, there's always exceptions to the rule, though.
Yeah.
So we do need to look at that, and we can and we do model dividend versus salary calculations. But the reason these rates were tweaked in many respects was to try and align the difference or the advantages of dividends over salaries for owner managed businesses.
You can see how those with more modest incomes, there could overall be some tax savings there.
And worth just highlighting.
Allowance.
Yeah. So I was going to say, worth highlighting that dividend allowance. That used to be £5,000. That was pretty generous and did encourage people perhaps to be a little bit more aggressive than they should have been, that we'll explore further, but now down to a relatively modest £500. So nothing to write home about there. So, OK, those are the rates of taxes on dividends. Let's start by exploring what are Alphabet shares and why they might be useful in family or doesn't have to be family businesses, does it, where you've got a number of shareholders?
Well, often a company will be incorporated with just one class of share. But as you pointed out, you can also split those shares into different capital, often with a different letter applied. And why is that advantageous? Well, again, it provides some flexibility over profit extraction. You can attribute different rights to each share class, and that might affect, for example, the timing of when dividends are paid. You don't have to pay everything out at the same time. We can also determine what level of reserves is attributable to each share class. A share class may or may not have voting rights, and there may be other rights attached to those shares, such as capital on an exit. I suppose it's worth pointing out, often one of the advantages of having shares is actually the capital gains tax implications on an ultimate exit. But, you know, here we're focusing on the income tax rules, but, you know, companies do often use different share classes for employee share schemes and completely commercial purpose to retain and incentivize staff. And I would recommend you perhaps watch Stephen Deutsch's webinar that he held recently on EMI and CSOP schemes, because that goes into some of the tax advantageous reasons why you might want to issue different share classes.
Yeah, and that's all on our website, as we said before. So you can call them what you like, really, can't you? I mean, that's typically you have A class, B class, C class shares, etc., etc. And as you, I think, made the point, Helena, we're focusing primarily on the flexibility to pay different dividends to different classes of shares here. That's the opportunity, and that's what HMRC sometimes as the mischief that we'll drill into. So that's what alphabet shares are. Nothing inherently naughty if used correctly, but why do HMRC get a bit excited about this?
Well, one, as we said, historically dividends have been more tax efficient, so there has been an incentive to perhaps carve out different share rights to different types of individuals. From 25-26, directors of closed companies will be required to state the percentage of capital owned and the dividends received. Now, the published guidance says this is due to they want to collect more data, better target administration and policy. That's fine, but they also want to focus compliance activities. So you could see how any kind of avoidance relating to shares may be affected by this rule. And there have been various HMRC published views on certain arrangements. Now, there was recently the Spotlight 62. We're not going to focus so much on sort of family investment companies, but this type of structuring which enabled companies to sort of pay out profits that could potentially, in a tax efficient manner, that could potentially be used to pay school fees, may involve the use of alphabet shares. There have also been some high profile tax cases involving certain types of share classes where potentially the income could be reclassified possibly as earnings. I think internally, as you indicated, we have lots of discussions about what the latest view is on alphabet shares. I think the point is there are so many different types. It's difficult to sort of target down into one firm view, but that's why we're going through all this legislation. I did want to also just point out, however, some of the tax legislation has actually been amended to almost accommodate different types of share classes. So some of the CSOP rules, the company share option plan rules, now accommodates the use of different types of shares for the purposes of that tax advantage share plan. And also there were some recent changes to business asset disposal. Well, wasn't that recent? I think it was pre-pandemic, but business asset disposal relief. And I think when the legislation was initially drafted, it would have sort of affected individuals who, for example, had growth shares that didn't entitle them to any kind of distributable reserves. And this 5% economic interest test was then changed, so it looked at proceeds on an exit. So if you've got 5%, again, I only mention that because, you know, it indicates HMRC are comfortable in certain scenarios about having different classes of share in issue.
Yeah, but I think there is a perception, isn't there, that alphabet shares can be used for nefarious purposes, and certainly if you've got 2 or 3 classes, I think that's not unusual. Where you're getting down to, you know, X, Y, Z, then certainly it would be suggestive that planning has gone a little bit too far. I think the other point we just mentioned, Helen, that we're focusing on alphabet shares. The tax issues are very similar if you use dividend waivers.
That's right.
Now, the perception might be slightly different insofar as you've not created all these different classes of shares, but the principles or the risks are still the same. If you are using dividend waivers to pay targeted amount to other shareholders, and all of the issues we're going to talk about here are going to be relevant. So although we are focusing on alphabet shares, the risks are very similar, which I think just the question we've just had in here about dividend waivers. So yeah, I think the risks are exactly the same, albeit the perception is not quite the same insofar as HMRC can't immediately see a whole load of different classes of shares. There's a little bit
more administration obviously involved with dividend waivers as well.
Yeah.
So, and a couple of risks there. I am going to talk about them later.
But just to flag that. Okay. So, as we said, we've got legislation that we'll look at, but what's caused a lot of the problems is the revenues publish views in their tax bulletins in previous years. Helen, do you want to just give us the sort of heads up here and their direction of travel before we had a bit of case law that was helpful?
I thought I'd go a bit, rather than starting on the legislation, I'd start here because this seems to be the area that has caused a lot of confusion, and again, there's a few misconceptions in this area. So effectively, we're talking about the settlements legislation. This is quite old legislation. I think it dates back to 1938.
Yeah.
The point being is it's fairly archaic in the way it's drafted. But effectively what it's saying is that, you know, we have this set of rules which can relate income back to a person who sought to achieve a tax saving. So within the bulletin, it says the settlements legislation can apply where an individual enters into an arrangement to divert income to someone else, and in the process, tax is saved. Now, what really set the hairs running was the fact that when they published this guidance in April 2003, and I think it was around the same time there was quite a famous case being heard through the various courts, the Arctic Systems case, HMRC came out and basically said, actually, we view these rules very, very widely. It isn't just the case that the settlement rules apply only to arrangements involving a settlor's spouse or minor children. Actually, a whole host of scenarios could result in income being sort of attributed to another person. Now, 7 professional bodies met and published, well, I think they've actually met with the revenue, but basically their issue was that some aspects at the time relating to HMRC's views were known, but key elements which affect everyday situations were not. And they particularly had issues because the revenue had come out and said, you know, arrangements involving ordinary shares with capital rights could be affected. In this instance, there was an example involving a husband and wife company, very similar to the Arctic Systems case that we are going to go on to. CIOT, the Chartered Institute, later published a paper on this. HMRC then came out and said, you know, reiterated their view in the previous tax bulletin. So this was in February 2004. They released Tax Bulletin 69. They acknowledged that a lot of accountants and tax practitioners did not accept their view. And, you know, specifically in relation to 3 cases within that tax bulletin, and a case that looked quite similar to the Arctic Systems case, which we are going to talk about. Now, it's been quite an interesting exercise just going through all of this past correspondence. And I would recommend also looking at this guide for smaller businesses, because within that, HMRC did publish 21 examples when they thought the settlements rules would apply, 10 when they did not. But ultimately, case law has changed some of these views, and the latest kind of published guidance is now within the Trust Settlements and Estates Manual. Now, a lot of the changes again came off the back of case law. As a result, 6th of December 2007, there was an income shifting consultation document published. We were expecting new legislation in 2008-9. That was deferred for further consultation, and it's gone a bit quiet since. Now, whether that was because it was the time of my favourite, the credit crunch, when I used to share an office with Tony, or there were other factors, but it has gone quiet in that regard.
It's gone very quiet, I think, to be fair to say, Helena. But I think what, as you said, what causes confusion is those tax bulletins are still out there. And if you try and sort of Google this with the best intentions in the world, you'll find that it doesn't say superseded in any way. And I think that has propagated a myth that, as we've said, has been superseded by case law that we'll come on to. And even the revenues manuals haven't been completely rewritten, have they? They have tweaked them, but frankly, they could do with sort of starting again. But look, that's where we are. We've heard nothing more since December 2007. I can't imagine it's top on the list of the government's priorities at the moment. But look, the starting point should always be the legislation.
Yeah, exactly.
So let's have a look at what that says. Then let's have a look at some of the case law. And then I think we can see how there's clear daylight between what's in those tax bulletins and what the legislation and how far case law has taken this. So where's the legislation, Helena?
I tell you, 2005, Part 5, Chapter 5. So again, it does date back. Actually, it is quite readable, I've found.
It's not the biggest bit of legislation, or
really
most impenetrable, but there you go. So go on, give us the heads up, Helena.
So Section 619, income is treated as the highest part of a settlor's income, and income tax is charged on the income of another person where the settlor retains an interest in the property. And
we'll talk about what that means. Yeah.
And then income paid to relevant children of a settlor, so effectively minor children. There are other circumstances when income can be passed back to this person's settlor, but what is a settlement? Really, it's very widely drawn. It's a kind of any kind of agreement, arrangement, I guess understanding that something will happen. But in order to be a settlement, HMRC say that there must be an element of bounty, and they reiterate this throughout their guidance. Now, this was a concept that was first determined in this Plummer case. So when does a settlor have an interest in property? So this effectively where if there are any circumstances in which the property or any related property income is payable to the settlor or settlor's spouse or civil partner. So, that maybe that is not an outright gift. Bounty, obviously there has to be this element, but it's what the revenue manuals say is it's the provision of something without something equivalent in return. Two parties not acting at arm's length. They do make the point that obviously purely commercial transactions are therefore out of the scope. So just to make this a bit easier, if there was some kind of gift from one spouse to another, there clearly would be circumstances in which the income or property would be payable to the other. And for that reason, there is a further exemption from these rules.
This is probably the key point, isn't it? Or where settlements legislation is most likely to potentially apply and where there are specific exemptions. So we're talking about between spouses. When we say spouses, we do mean civil partners as well, don't we? So forgive us if we don't repeat the phrase. We do mean the two interchangeably. But okay, Helena, when does this exemption apply?
So effectively, one partner makes a gift to the other. Now, it must carry the right to the whole of the income of that property, but it must not only be a right to income. We're not just purely diverting income to the other. So, you know, if you gave some shares to another person that had capital rights, that might take you within this exemption. Now, it must be a proper gift. There can't be conditions attached to the gift. There cannot be any circumstances under which property or related property is payable to the person who gave you that gift. So if you looked at a sort of husband and wife company scenario, if they both had ordinary shares or alphabet shares, or one party giving shares to the other, you know, there must be capital rights attached to those. But equally, and I think we'll go on to make the point later, if all the cash comes back and is paid into the same bank account, then arguably, you know, the income is available to the giver and you would be in the settlements rule.
Yeah, I've never seen the revenue take the point. I think you're absolutely right with husband and wife companies. You do need to be careful if the money goes into a joint account and both can draw down on that, then I take your point, Helena. It is, the money could still be used for the benefit of the gifting spouse. So I think we do recommend having separate bank accounts. Even then, I mean, how far do you take this? But I think at the very least that would be best practice. Now, what all of this means, how far it goes, how it should be applied, well, this all comes back to sort of the Arctic case that we're about to look at, doesn't it, Helena?
Yeah, just before we go on to that, I mean, gifts to other persons, the rules here are a lot less restrictive. So this is probably why the revenue was saying, oh, well, most people think that only sort of spouse and minor children. Actually, other people, including adult children, can, or gifts to them can also be brought within these rules. But again, reiterate the point, it's if the settlor retains an interest in the property. So again, is there an outright gift? Are there any circumstances under which the property or the income is payable back to the person who made available that property?
So yeah, I think we'll talk about examples, but if there's an understanding that the shares will come back to the original shareholder, that's the sort of thing that might be caught. So as you said, Helena, just to summarise, we do need to be careful with spouses, and that these rules can still apply on gifts to anyone if, as you said, there is a retention of some sort of benefit or interest in the underlying property, or the person making the gift somehow can benefit from it. Talks about the relevant income, doesn't it? The dividends from the shares that we're talking about here. Okay, thank you for that. So let's move on now to, I think, the key case in this, Jones versus Garnett or Arctic Systems to you and I, but revenue got a bit of a kicking here, didn't they?
Well, they did, but having said that, it did go through various rounds, didn't it, ultimately?
Oh, yes.
So
eventually got a bit of a kicking then.
So effectively, there was husband and wife company, 2 shares in issue. Now, they weren't alphabet shares, but the principles would apply equally in this scenario. Jeff was an IT consultant, so he was the main person doing the actual work. Diana dealt with the bookkeeping, secretarial and admin work. Small salaries were taken and then substantial dividends were paid out on a pro rata basis, 50-50. Now, again, it went through various rounds. So we look at the Court of Appeal. They decided there was an arrangement, but the element of bounty was missing. And the House of Lords ultimately, because the revenue challenged this, they said, well, look, the ordinary shares are not substantially a right to income. Diana's got capital rights. And therefore, it was completely contrary to some of the examples which HMRC had actually given in their tax bulletins, which spoiler alert, were probably based on this case, I think. So, but again, went through various rounds, and then after this, HMRC ultimately did change their guidance on their website.
I think, just so I understand this correctly, I think the revenue sort of starting point was, well, Jeff's doing all the work here, and yet his good wife is getting half of the income. That surely is a settlement. And I can accept there's an element of bounty there, but as you say, it wasn't just a right to income. She had equal rights to capital. I mean, I don't think voting is too relevant, but that's the key point here, isn't it? If those shares only had a right to dividends, and we'll see some rather blatant cases shortly, there might have been a problem.
Yeah.
But an outright gift of shares that have full capital and dividend rights, subject to this point about the money not effectively coming back, or the shares coming back to the husband, then I think Arctic Systems has set some clear daylight from the revenue's previous views.
Well, I think as well, I mean, the issue share capital was £2. I think one of the arguments was well, just paid £1 to receive this and not. Again, I think it's just one of those things where you kind of say, does it meet the smell test? Probably didn't meet HMRC's, but ultimately, if you look at the legislation, it is quite clear. But yeah, I take your point.
All right, Graham's asked a question, Helena. So we're talking about dividends being paid into joint accounts. And Graham's saying, well, in many cases, dividends will be credited to directors' DLA, director's loan account, rather than paid as declared. Does that make it any more or less risky? I mean, I'm not sure it makes any difference. I think it's where once the DLA is drawn down, what happens to that money would be my view. So I'm not sure it really changes things, but
I don't think it does.
No. OK, but thank you for your thoughts, Graham. So that was Arctic Systems. And as you said, the revenue have updated their manuals. Just Google it. It's all there on public record. Just talk us through what they now say, Helena.
Well, if you look at 4225 of the Trust and Settlements Manual, they do say they will normally only invoke these provisions in a sort of husband and wife scenario or spouse scenario where dividends could not have been legally paid across all relevant shares without there being a dividend waiver or a separate class of shares. So effectively what they're saying, we've got a level of profit. We would expect for a 50-50 company for the profit, for each shareholder to take 50% of the profits. Now they do give an example here of what they call a bounteous arrangement. So you've got Mrs. I, who has A shares, Mr. I has B shares, and they hold the shares in the proportion 80-20. Now each share ranks equally. But overall, the profits for the year are £25,000, but actually most of the profits have gone to Mr. I. So that would be a type of arrangement where HMRC would say, well, that's kind of a gift of income, really. So we think the settlement rules apply. Now, there have been other cases that have been quite similar. There's the case of Young versus Pierce, Young versus Scruton, where shares were issued to wives, B shares, and actually dividends were mainly voted on those B shares. And again, the revenue thought that was mainly a right to income, and therefore the settlement rules applied. Yeah,
but let's be clear: if a company's got £1 billion of reserves and one spouse chooses not to take a dividend that year, then you're certainly at risk, but it's not every dividend waiver that benefits a spouse is necessarily caught here. And I think they do say they'll look at the history of dividends as well, won't they, in certain circumstances?
Yeah, they do. I mean, with any of these things, the revenue at pains to sort of stress that they would look at everything. It's not just one. Yeah.
To be fair, I mean, there's good guidance in the revenues manuals now, isn't there? I think
it's very clear.
Yeah, I think the one thing, as we say, the curveball is they're still out there. The HMRC's previous guidance in those tax bulletins that really has been superseded. So have a look at the manuals. They're not perfect. They seem to have been sort of tweaked rather than completely rewritten, but they will, I think, give you a certain amount of help and comfort in many circumstances. So that's husband and wife. There's also some examples for non-spouses or civil partners, aren't there, Helena?
Yeah, I mean, what the revenues say is, and much the guidance actually might be quite unusual. It may well be unusual for settlements to apply in these sorts of circumstances. However, they do give one example, and Tony alluded to it earlier. You've got Mr. C, who owns shares in a company. There's cash in the company. He's a higher rate taxpayer, and he wants to give his brother a gift. So, but the cash is in the company. So what can he do? Rather than take that cash out at the additional rate of tax or whatever rate he's paying out, he transfers half the shares to his brother, but on the understanding they will be given back. And then they pay out pro rata dividend. So you kind of go, well, that's great. But actually, it's all done on the understanding that Mr. C will get his, so he retains an interest. So immediately you sort of slap bang in those rules.
Yeah, so that's a case where, as we said, as much as we generally focus on husband and wife, that sort of planning doesn't work. Now, it is a little subjective. I mean, what understanding was there? We certainly wouldn't suggest give the dividends, give the shares on day one, pay a dividend on day two, hand the shares back on day three. But if, completely independently, 5 years later, the shares go back, it could, the revenue would still be entitled, I think, to ask the question. So there's no safe harbour as to how long. It's all about were there arrangements at the time. So a little bit subjective, but I think the legislation is quite clear as to what it's trying to achieve, and there are risks where you start moving shares backwards and forwards and paying dividends in the intervening periods. So that's where the rules can apply for non-spouses or non-minor children. Couple of cases here, or certainly Bucky's the one I always remember, Helena, where it was very, very aggressive. Tell us about Buck. It clearly didn't work, did
there's
it?
10,000 shares in issue. Wife had one. I don't think there were alphabet shares, but there weren't, because it's dividend waiver. But effectively, a very large amount of, I think it was over 2 years, dividends were paid out.
It was 6 or 7 figure sums, wasn't it? I seem to remember. It was very large, I seem to recall.
Donovan's another case. Insufficient distributable reserves in this case actually wasn't conclusive, but the payment of dividends to wives, I think on some preference shares, but double check that. It was just decided there was lack of commercial purpose here. Revenue make the point in their manuals that it's unusual to see dividend waivers outside a sort of family setting, unless there is a genuine commercial reason. So, again, lower risk for than possibly we've been led to assume. I would just say with dividend waivers, obviously there's various, it's a legal process. I think it has to be done by way of deed. And don't wait until after the dividend's been declared, because effectively at that point you are just giving someone income, and it would be taxable on the shareholder.
Yeah, it can, as you say, it can have other implications as well. It can have IHT implications as well with dividend waivers, which is one for another day again. But yeah, I mean, Buck, as I say, is that it's the clear point was there's no way that level of dividend could have been paid on the wife's one share. That was the element of bounty between spouses. Absolutely 100% caught. No sympathy whatsoever in those circumstances. So yeah, don't do anything that is wholly aggressive as that. It's just not going to work, even post-Arctic. Other scenarios, Helena?
Just very quickly, because we need to possibly move on given the time, but partnerships, HMRC do make the point that partnerships technically can be caught into these rules. It's not just companies, and actually all the settlement rules do cover other types of income charging provisions. So also rental income, if you had a jointly owned property, although certain aspects of the HMRC guidance say, yes, fine, I can give another person a larger proportion of that income. You could technically be caught under the settlements rules. They are broader than obviously just having alphabet shares in a company.
Yeah, so this is where you give a spouse a share in a partnership and they take a profit share, but where they don't have the capital rights associated with it, where the understanding is, that partnership interest will come back to you again. That's the sort of planning that HMRC can and may well object to. So let's just summarise, Helena, before we move on to the other aspect we need to consider carefully, which are the employment-related securities rules.
So, it is mainly going to be spouses and civil partners and minor children that are going to be caught. And we would make certain recommendations. We've already discussed this point about paying into separate accounts. The but case, even if both shareholders had held different classes of share, in principle, there can be a gift of income if dividends are paid disproportionately, and that's significantly disproportionately. Dividend only shares aren't recommended for spouses for the fact that, effectively it could be construed as a gift of income.
I think it would, yeah.
And then gifting shares and re-gifting back, as with that non-spouse example, probably not recommended either, because the settlor or the person, the giver, will retain an interest. For others, including adult children, must be an outright gift with no way that the transferor will receive any benefit. And again, distributable reserve should just a bit of caution with waivers, all with alphabet shares, and just consider the commerciality of arrangements.
Okay, let's pause for breath for a second there. Thank you, Helena. Now let's move on to employment related securities. The rules are in ITEPA 2003. Very much linked to what we've been talking about. A couple of important issues here we need to consider, Helena.
So we're looking here on possible income tax charges related to the person who receives the shares or is issued with the shares, because there can be, under the sort of general earnings rules, if sufficient consideration is not given for those shares and that individual is an employee or they're connected with an employee, there can be income tax charges that arise. Separately, depending on the rights attaching to those shares under the employment related securities rules, there can be subsequent income tax charges if something happens in the future relating to those shares. So often we are looking at when certain restrictions are lifted, or including on sale, there may be additional charges. And again, we'll go on to this in another session, but there is something called a 431 election that can be made to mitigate some of these subsequent employment charges.
So let's just drill down a little, Helen. They're talking about share acquisitions. Time marches on. I think one of the sort of misunderstandings we often hear is when an employee receives shares, people will often say, well, you've got an employment related securities charge there. Strictly, I think the principle is right. There is a risk of an employment tax charge, but strictly, if somebody receives shares by reason of their employment, your starting point is section 62. Effectively, it's a benefit in kind. It's a profit from your employment that is taxed under general principles rather than the employment related securities rules. Now, you do need to be careful here. There is a bit of misunderstanding. The employment related securities to rules talk about by reason of the employment. That's much broader than section 62, that if we sort of cut through the case law and the guidance and legislation, is from the employment. That's a lot narrower.
Yeah.
And technically, it is quite a narrow line there. There is an argument to say that if an employee gets shares, it may not be from the employment, a reward. It's certainly by reason of the employment, but may not be from the employment. Why is that relevant? Well, have a look at David Wiscombe's article. It's in Tax Journal. It's also on our website, Fine Line Between ERS and Shares for an Employment. There is an argument that you're not taxed up front under Section 62 on the receipt of those shares. Instead, you are in the employment-related securities rules, which may only impute a charge when you dispose of those shares. Now, I've probably confused rather than helped here. I think the principle is you receive shares from employment, there is a risk of employment tax. Have a look at that article that drills into it in a bit more detail.
One of the best things I've read on and that's not even me being biased. He also name checks J.K. Galbraith, which Tony was impressed with yesterday.
Certainly impressed. Right. So, since I've confused everyone already, let me go a little bit further here then, Helena, and then I'll hand back to you. So, employment-related securities rules and family members. Now, the employment-related securities rules has a deeming provision that says broadly, if an employee gets shares, they're always deemed to be by reason of the employment and therefore within the employment-related securities rules, unless you are given the shares in the normal course of domestic, family or personal relationships, and the person giving you the shares is an individual.
That's right.
Now, this causes confusion if you have a look at the revenues manuals. The revenues manuals, let's say I hold shares in my trading company, I'm a director, and I give those shares to my son, AJ. Quite why I'd want to do that is completely beyond me and Helena, who knows AJ. That's another matter. I'm giving AJ those shares not as a reward for employment. I'm giving him a normal course of my family relationships and as an individual. The mistake people make, and I think the right guidance doesn't help you here, that does not take those shares outside the employment-related securities rules, full stop. It merely means AJ hasn't received them by virtue of his employment. They start as employment-related securities in my hands, and they remain in this sort of box, as the revenue describe it, until those shares sold to a third party. So if you read the revenues manuals, you might think I give them to my son, whether or not he's an employee stroke director in the company, because they've emanated from me, they remain as employment-related securities. The difference is when AJ receives them, he's paying nothing. He's not taxed under Section 62. It's not a reward from his employment, nor is there a Chapter 3C charge. What am I talking about here? Chapter 3C charge is the one that says if you don't give full cash value up front for those shares, it's treated as a beneficial loan. And it's driving at the sort of scenario we say, well, you have to pay full value, but you pay in 100 years when Spurs next win the league kind of thing. Yeah. So you're never actually economically paying for them. Because that acquisition isn't by reason of the employment, there's no Chapter 3C charge. So just clarify that, as I say, the revenues guidance is a bit misleading. Let's take another scenario, though. Let's say I'm a passive investor in a business and I give my shares to AJ. Even if he is a director, then that exemption would apply. I've given them to him in my normal family domestic relationships. I've given them to him in my capacity as an individual. Therefore, even though he's an employee, they are not deemed to be employment-related securities. Was that about right, Helena? Okay, so hopefully we've clarified that. If they're in that box, if they're in employment-related securities, they stay in that box until the shares are sold to a third party or in similar circumstances.
Something that happens to the share rights, which then causes them to increase in value. That's why particularly in the first scenario, that would be relevant. But just watch out. The revenue also say you need to just look at the circumstances under which a relative receives shares. If they work in the business and other non-connected individuals receive shares, then the chances are they are employment related securities. The manuals covers this again.
Okay,
talk about friends, but.
And we've been asked the question, does your son need to sign a 431 election? Well, if they are employment-related securities, very possibly. Depends if they have restrictions, I guess. I
often would argue signing a protective one in certain circumstances.
That's a whole topic in its own right. So we're just, again, a bit of I think an area that's misunderstood. Let's talk about employment-related securities and dividends, Helena. This links back to Alphabet shares. So go on, back to you.
Okay, so Part 7, it's a huge area of legislation, but which aspects of it could affect our holders of the Alphabet shares? Now, the first area is this Chapter 3B charge, when there is a non-commercial increase in value. So the revenue, excuse me, considered that once dividends are declared, that could result in an increase in the value of those shares. And under the rules, anything done otherwise than for genuine commercial purposes could mean, therefore, that uplift in value could result in an income tax charge. Now, what the legislation actually says is that uplift needs to be by more than 10%, but effectively the risk here is you've got that income tax charge because the value's gone up, but also when the dividends come out, they will be taxable, and there may well be exposures to NICs. Now, what we'll see is actually that 10%, the way it's, when do we value it? It's actually at the 5th of April each year, and therefore, if you're declaring dividends at a different time, I'm not quite sure necessarily how that declaration of the dividend would ultimately result in a huge increase in the value.
Yeah, we've looked at the legislation. We don't think it says quite what the revenues say. I mean, we'll come on to an example in a minute of the sort of planning that is very aggressive, and we wouldn't recommend it anyhow. But do have a look. Feel free to disagree with us. I mean, our point is, once the dividend's been voted and paid, well, once the dividend's been voted, the value of the shares goes up. Once the dividend's paid, they go back down again. So it's hard to see how that affects the value on the 5th of April. The revenue say it's that spike on the voting of the dividends that attracts the Chapter 3B charge. We're not quite sure.
No relief on the fall.
Yeah, absolutely. So we'll see exactly the sort of examples the revenue really do object to, and we certainly wouldn't recommend. So that's a Chapter 3B charge. There are other charging provisions here.
I mean, there's this post-acquisition benefits from securities. It's a sort of catch-all provision. Back in the day, Dawn Primarolo used to be all over, really understood her brief and the tax legislation and what it was supposed to achieve. And she came out and sort of explained that really it's this section's here to target complex, contrived avoidance arrangements. And it's more likely that if we're in a scenario where we've got something complex, contrived, actually taking profits out as a dividend, that dividend will just be taxed as earnings.
I mean, just to flesh that out a bit, the legislation is only very short. It's a couple of chapters that talks about if an associated person, that's the shareholder, or don't try and direct things to family members, is the gist of it, receives a benefit in connection with employment-related securities. It's really broad. The Revenues Manual talks about giving bottles of wine to shareholders and such matters. So it can catch anything. But again, I think just to highlight the fact that it's really targeted at quite contrived anti-avoidance scheme that we would never recommend.
Hence, we look at dividend only shares.
Yeah, well,
sort of thing. The PA Holdings case, it's quite a famous case. It's also quite a complex case, but effectively payments were being made that really were in the nature of earnings. And I think the additional complexity to do with this is that didn't they try and claim a corporation tax deduction as well as try and pay out the dividends as dividends, but effectively the shares had no really restricted rights, and I think the takeaway is that shares with no voting rights, rights to capital, are going to be more susceptible to be treated as earnings, especially if they are forfeitable by leavers.
Yeah, so as we say, that's really pushing the boundaries here. The other example the revenue give is where, and this was particularly highlighted by the £5,000 dividend allowance that did sort of encourage this planning. You give each employee a separate class of shares. So, you know, Bob would have a Bob class right of shares that only had a right to dividend. And this was giving you the reference to revenues manuals, and you'd vote a dividend on that single class. These shares had no capital rights, no voting rights, just an entitlement to a dividend. You'd vote them £5,000, tax free. What's not to like? Well, again, we certainly wouldn't recommend that sort of planning, and that's the sort of thing they would attack with these Chapter 3B charges. The shares have no value except when that dividend is proposed, that value goes up. In the revenues and ISU court, subject to what we said about the legislation, perhaps not quite saying what it think it does.
Got no real stake in the business, they
No.
say.
And I think this is the point, isn't it? We talked about perception here. Where you have 1,000 classes of shares, you are going to attract revenue attention because they will well suspect you are doing this sort of mischief. Now dividend rates have gone up. Now the dividend allowance has gone down. Frankly, it's probably not worth the aggravation anyhow. And well, for what it's worth, we don't think it works, albeit you might have a technical debate with the revenue on how Chapter 3B actually works. So those are dividend only shares. Nearly there, Helena. Do you want to take it away?
Yeah, I think as we've indicated, there may well be some defences against employment charges, or rather those employment charges just don't arise. If you've got full voting capital dividend rights, well, the value probably sits with the share capital itself rather than any income rights, and therefore you'd be outside these rules. Probably watch out in a situation where you're voting very, very large dividends on shares, which could materially decrease distributable reserves, increase value by more than 10%. However, as Tony said, we've got this other point about the date on which the value of the shares is measured. So, you know, again, review dividend only shares. There will be scenarios when it might be acceptable. There may genuinely not be a substitute for earning salary. So every case needs to be looked at really independently.
Certainly if it's linked to a salary sacrifice arrangement, you are on dangerous ground. But look, I guess the starting point is, are they employment related securities? Don't assume they're not just because you've gifted them to a son, and be slightly, I think, not deliberately, but perhaps inadvertently misled by the revenue's guidance on gifts of shares to children. And then the question is, you know, well, you don't really want to get into debate with revenue about valuation and whether it's more than 10%, but just be aware, just because you're not caught by the settlements legislation, you do still need to consider the ERS rules where you are paying targeted dividends. So I think just about finally, Helena, sort of quasi partnerships. I think we're talking about sort of companies, and I've had two examples of this in the past couple of days, which sort of are operated like a partnership, but are owned by, say, 2 or 3 shareholders. And you may have a scenario where you have Alphabet shares and one shareholder receives an additional dividend 1 year. And it might well be as a reward for the additional work he's done there. What are the risks here?
Well, effectively, we are, you know, is this a kind of commercial arrangement? I think if we've got full vote, it's very different to a scenario where you wouldn't have full capital rights. And actually, if the article set out that differential dividends can be paid, it's of a lower risk. Where I would have an issue is if you had 2 shareholders who owned a company 50-50, they amended the share rights to effectively flick a lot of value into the other share class, and then, you know, not only have you got a risk of capital gains tax, but this post-acquisition changes in value points. So yes, I take your point. I think you just need to tread carefully depending on what you're doing, but on the basis that these are three unconnected individuals, there's probably a lower risk. I did see in one of our technical publications actually that someone had addressed this with the revenue, because the revenue had raised the point, but ultimately it had been dropped and nothing had been seen since on this precise point.
I mean, I think the other point we've mentioned there is NICs. What you don't want to do is say, dear shareholder A, as a reward for all the excellent work you've done, here's an extra bit of dividend. I think then the revenue it would still be a stretch, but could argue it is within the ambit of NICs. Now, we've yet to see them challenge that. We did talk about the PA Holdings case there, but that was particularly aggressive, complex, uncommercial arrangements. So we can't completely rule it out. And look, we would never suggest, if you pay somebody a dividend, it should purely be in their capacity as a shareholder, not a reward for work. And therefore, I think it would be quite hard for the revenue to challenge that, and how they would sort of distinguish between the extra dividend that's subject to NIC and the normal dividend that everyone else is getting would be difficult. So not completely without risk. We'll keep an eye on that and see if there are any developments. So just finally, a quick word on family investment companies, Helena.
Well, they've been subject to various HMRC reviews. There was, if you remember, there was a task force set up. Ultimately, I think a bit like the consultation on husband and wife companies, and although nothing subsequently, I think they did indicate that it may be something that will be looked at in future, or could be looked at in future. Why this has become more of an issue is obviously we've had a lot of press on some of these arrangements which would allow perceived to allow dividends to be taken out of companies in order to pay school fees, and those dividends come out to effectively minor children through various routes. And again, there's a lot of press on it. Spotlight 62. I suggest we cover it in a later session, but this is sort of the type of area where there may well be a little bit more HMRC activity.
Yeah, but again, I think we should make the point, family investment companies can be used for wholly reasonable, fair, non-aggressive tax planning, can't they? So again, the name is somewhat tarnished by the odd occasion where they have been used in areas they shouldn't. I think we may well have done a previous webinar on that. I can't remember now, but if we haven't, well, maybe that just highlights the point. Okay, thanks, Helen. Let's just finish off then, just to highlight some of the misconceptions we've talked about today.
So firstly, I would recommend, if you've got the time, just kind of going back through all these tax bulletins, the follow-ups from the CIOT, and then ultimately looking at the HMRC manuals. As we said, the guidance really might not be as widely drawn as it's often assumed, but this is partly because a lot of people focus on the comments in that tax bulletin. Indeed, the HMRC manuals do make the point that in most everyday situations the settlements legislation will not apply. Now, there's lots of really good examples within that 4355. I think they're specifically cover cases when settlements wouldn't apply. Other common misconception, this point about section 62 taking priority if shares are from the employment. And then again, this issue about the 10% test for the purpose of when you value the shares. I mean, when is it likely to buy in that case?
Yeah, but I wouldn't like to rely on that in some of the more aggressive planning. But,
no.
But if anyone's got any thoughts, do drop us a line. So in summary, Helena.
Okay, I think as we said, there's been a little bit of internal discussion here about, where do we stand on Alphabet shares, and, subsequently, HMRC have announced this consultation. They will be gathering more information on share ownerships and dividends paid. Whether that will impact directly in this area, let's wait and see. HMRC already have a lot of information on shareholdings because of the ERS reporting. So just a quick reminder that forms are due in by the 6th of July. They are fairly detailed these days, but in terms of settlements legislation, yes, particular care is required in respect of spouses. We've looked and civil partners. We've looked at some scenarios where there may be issues, but in particular, avoid paying dividends in excess of pro rata share entitlements, and use of dividend-only shares in that sort of scenario is really not recommended.
Yeah.
ERS rules. There's no equivalent kind of spousal exemption, but we've got this family exemption. But as you know, as Tony noted, it's not a given that it applies, but also it doesn't necessarily apply in the way that we think it does. And finally, just look at the rights attaching to shares and dividend policy. Could dividends be reclassified as earnings? Obviously, with income tax rates going up, dividend rates, how much of an issue is there? But bear in mind this point about the NICs.
Okay, so look, I think the bottom line is care needed. Do seek advice. We're here to help. We can certainly help with ERS reporting. There's no, every case needs to be looked at on its merits, I think. But hopefully that has displaced a few myths and misunderstandings to do with these rules. They are complex. There are careful interactions. We've only touched upon the surface of some of the employment related securities rules, and as we say, maybe that's one for another day, but we hope that's been of use. If you have any further thoughts, do of course let us know. As I said, we will send copies of these slides. Catherine's been beavering away already and trying to have a look at that article by David Wiscombe. She said she was struggling to copy the link, so apologies, Catherine.
Definitely is on there.
We'll check that on our website, but it is there because I had a look at it as well yesterday. Maybe just overwhelmed by sheer volume of people going on that page at the moment.
It's pretty good.
But as I say, we hope you find that useful. Thank you very much to Helena
Thank you
for your thoughts. Thank you very much to Lola sitting in the background and assisting us. And we very much hope to see you soon and to introduce you to, as I say, our new colleagues at Wilson Wright. So thank you all very much, and we hope to see you again soon. All the best now. Bye now.